the wealth game. Earn dollars, buy assets, borrow smart.
The next is more intermediate investing.
And so as a dentist, this would be the equivalent.
As long as that asset value doesn't come crashing down, you're safe.
From being an associate to being an owner, making 300K a year, now you're making 500K, a million or more, right? I know it's going to seem very contrary, but you build up.
You essentially can live off the debt against that asset and you're not paying taxes on it.
They don't practice it as very low risk. Your $2 million is going to go up by 8% a year. Welcome to the Wealth Strategy Session.
This is where we unpack one key wealth building strategy at a time and show you how to apply it.
We have a great show today. Our wealth strategy session topic, the wealth game. Earn dollars, buy assets, borrow smart. With me today is the Sultan of Smart Money, Dr. Reed Faldet. Reed, so glad to have you.
So glad to be back.
Happy Friday.
Happy Friday. Happy Halloween.
Happy Halloween. You can tell that Reed and I are super into holidays, right? Like I buy our attire if you're watching on YouTube. Reed and I were actually chatting about this pre-show. Reed and I are such like providers, like at our core, right, for our families, that like we love holidays, we love getting into them, we love the rituals, we're grateful for them. But when it comes to like our autonomic like priority list, we prioritize like providing for our families, and yeah, obviously we're not dressed up, we should be,
Yeah.
but it's just not natural to our priority list. So
we could say that we're weak in this area and it's an area we can improve, is loosen up a little bit and maybe like dive into the holidays and traditions more and make it more like top of mind, especially with kids. But so it's also like not necessarily always a good thing. We're, trying to be better and embrace it a little bit more.
yes, we need to channel our inner Clark Griswold.
Yes. He's your avatar. He's your dad avatar. I remember.
He's in there. Reed, who are we trying to help and what problem are we trying to solve today?
Yeah, so we were discussing this before. I made a post about this in our private Facebook group, just about this topic and kind of going into depth about it. So the whole concept of earning dollars, buying assets, right, and then borrowing smart is along the way. I think we all know that investing is, right? You invest, you earn your dollars and you invest to buy assets that can produce some kind of return for you, like either via cash flow or via appreciation or whatever. And so ultimately it can make work optional for you in the future. Now we're going to get into kind of like more advanced level strategies, because what we're going to talk about is basically borrowing off of assets, like once you accumulate them. So think of it as if we have levels of wealth, and we can kind of articulate these a little bit. I think we can dive deep on a future show on this, but if you have different levels of wealth or wealth building, that this is really kind of like level 4, like more advanced strategies, but they're really fun to think about and kind of, begin with the end in mind. Because as you accumulate assets and you invest, your investing strategies get more and more sophisticated. Like you can start to employ more and more sophisticated strategies for a variety of reasons, whether it's tax mitigation, whether it's, optimizing return, whether it's security and defense, it doesn't matter. So Josh, do you want me to kind of lay out my levels, or do you want to speak to the levels a little bit of wealth?
Yeah, I think your brain is a little more runs a little more structured than mine. So I think it's always good for you to do that. Yeah.
Okay, I'll do my best here. So if we're gonna just outline like the 4 levels of wealth, and we're gonna start with entry level 1, it's really just establishing a good income and a good savings rate, right? So that you have the ability to invest. So you kind of have to get out of that like fight or flight survival mode where you have more than enough, right, to at least cover the basic needs of life. So then you can start investing. So that's kind of level 1. Level 2 is going to be your entry level investing. So maybe you start, and not saying this is the best strategy, but just most people start with, okay, I'm going to open up a stock market brokerage account, right? Vanguard, Fidelity, you're going to start investing, or maybe you open up a 401k in your practice or something along those lines. So now you're actually starting to invest. The next is more intermediate investing. So say you've filled up some of those traditional buckets, right? Like you've invested in your 401k, maybe you have that stock market brokerage account. Maybe now you're going to start going into more private equity or real estate syndications, or you're going to start buying investment commercial real estate yourself or whatever it is. So now you're just kind of going into that next phase. And level four is like, oh, I've accumulated a lot, right? I have a large, stock market portfolio, a large Bitcoin holding, a large real estate portfolio. It doesn't matter. But now you have a large accumulation of assets. So now you can start to play different strategies on those. So that's what we're kind of getting at is that level four is, okay, we've accumulated a decent amount of assets. What can we do with those? Thoughts on that, Josh?
I think that's good. Let's start with level one and we'll go from there. Or do you want to just focus on four?
Well, I mean, we can. I think, like you said, we've hit kind of some of this before in the past, but
Yeah, that's
you know,
true.
so I think we should save kind of those levels for a different show where we can kind of unpack them and go kind of deep if we want. Like this is what you should be doing in level one. This is what you should be doing in level two, right? Because I don't think we've clearly outlined exactly. Uh, we've kind of solidified the structure around that.
Think we did one show on like one and two pretty deep. Okay, yeah, let's just focus on four today and I'll try not to get distracted and go into the other ones.
We
Sounds
both
good.
know that we both know that's not going to happen. You'll get pulled back into those other ones. Um, I think this goes back to like Josh. I'm sure you've read it, right? Like the Rich Dad Poor Dad book, right? I think a lot of us have read that book of just like the what is it the quadrants, right? The cash flow quadrants. You know, W-2 earner, small business owner, a large business owner, investor, right? So like I think we all know kind of at our core that we have to own assets, right? If you want to kind of get out of working and you want to build significant wealth, you have to own assets. So in this specific thing that I laid out here, it's really like so I can pull up the article that I kind of wrote on it, but it stemmed from a reel that I saw on I think it was on Facebook or YouTube or something. But it was basically this guy who was talking about, let me pull it up here. What was the guy's name? And maybe people have followed him. His name's Mark Moss. Have you heard of him, Josh?
Mm.
No, so he's like a tech founder that has kind of pivoted and got into like the Bitcoin space. And just what I thought was really interesting was how he kind of outlined like you basically buy enough Bitcoin. This is it doesn't have to be Bitcoin, but I'm gonna use Bitcoin for this example, right? Is you buy enough Bitcoin and then you take leverage out on it, right? So if your debt if your asset is appreciating faster than the debt is accumulating, you have a delta there, right? And so as long as that asset value doesn't come crashing down, you're safe. You're safe because you can buy, let's say, $100 million. Say you own an asset, $100 million, and you can take out 50% leverage on that, right? And your debt is 10%, but the asset is appreciating at 20%. As long as that continues and there's a gap there, you don't have to worry about what's called a capital call. And so you essentially can live off the debt against that asset and you're not paying taxes on it because debt is not income. So the very big wealthy guys like Elon Musk, Jeff Bezos, billionaires do this with their stock, right? So the like Jeff Bezos, if he owns how many billions of dollars worth of Amazon stock, he doesn't want to liquidate his stock. And so what he does instead is he does a securities backed line of credit where he takes a loan out against his stock and then he does what he wants with those loan proceeds. It's the same concept. So if you own $1 billion worth of stock, I'm sure he can take out, $500,000 or $500 million of loans, and then essentially he's living off those loans and not paying
So,
taxes.
and not paying taxes. And so, as a dentist, this would be the equivalent of, I know it's going to seem very contrary, but you build up you get through level one, right, where you're building your dental practice from being an associate to being an owner, making 300K a year. Now you're making 500K, a million or more, right? You, everybody likes that feeling of paying down their practice debt, right? Paying off their house is creating that security in their life, not making those payments anymore. So, but the equivalent of what Musk and all these guys do against their stock is literally having a thriving practice, right? That let's say, earns you like a million a year. Okay. It's going to the bank and saying, hey, I've got this practice. It's unencumbered. There's no loans on it. I'd like your lowest interest rate loan on this very low risk asset. Okay. and you can make it like a line of credit, right? And those are usually variable. And for stocks, they'll usually lend like 75, 80% if you're in index funds of your like value of your stocks. With Bitcoin, because they see more variability in that volatility, they'll only lend, I haven't researched it, but use the number 50%, right? So
Mhm.
a dental practice that has very low risk and has an established track record and all these things, like if you find the right bank, you might be able to get like a pretty good line of credit, right? Let's say at a 5%. So the idea here is, I'm not saying this is what you should do, but I'm just giving you an idea of with your dental practice, you could do this, right? So you could take a loan off of that cash flow of your dental practice, and then try to invest that at a higher rate than your debt rate of like 5%. And because you control that asset, right now you're not victim to the ups and downs of Bitcoin prices or the ups and downs of the stock market, right? You're your biggest victim, you're probably a victim to like macroeconomic effects that might affect the profitability of your dental practice, right? But you have a better idea of that. Anyway, so that would be kind of the equivalent of Elon Musk taking loans off of his Tesla stock. Um,
So yeah, that's a great way. And I do that. I mean, I don't always employ that line of credit, but I have one against my practices. I just always want it there because I don't know if I'm going to need it, right? And sometimes I might have a phenomenal investment opportunity where I'd rather, draw on that line of credit or uh, draw down my liquidity a little bit and then have that line of credit to refund it if I need to. So there's a lot of people will have a line of credit available, and some of the wealthiest people I know have large lines of credits available. It doesn't mean they're going to use them, but it's nice to have them there so that when you do have a great opportunity or you feel like you need it, you can draw on it. So,
and the classic thing here, the classic example that I see the most is like TD Ameritrade. So if you have like a large enough account with TD Ameritrade, or I like to use IBKR, which is like for professionals, you can get really low rates, like maybe like 2% less than a bank would offer you. Okay. And you just make sure your investments are not in stock, like individual stocks, right? That's gambling we've talked about. So it needs to be in like index funds. Okay. So if you have it in index funds, like back in the day, they were doing like 2% loans, line of credits, right? So this is like 4 years ago. Okay. So imagine that. Imagine that you had $2 million. Okay. I think that was like their threshold, $2 million in index funds sitting with TD Ameritrade. Okay. And maybe it's 5 million, but I think it was two. That bumps you up to like a really good line of credit tier. Okay. You know from historical numbers that on average, your $2 million is going to go up by 8% a year. Okay. So you don't want to sell the stock and pay that tax, right? So what you do instead is you borrow 1.5 million from the stock. So your 2 million is still getting that 8% return. Now you're borrowing 1.5 million off of that 2 million from TD Ameritrade. And like today's numbers, like the best you're probably going to get is 5%. But in the past, like I said, two. Now you're saying to yourself, I'm only doing this because I have an investment that I feel very strongly about because this creates risk, right? It has to be a very low risk of investment. Like Reed and I typically will buy like a building, right? Or like I build experimentally now, but like historically, like let's say a few years ago, this would have been I bought a building where the initial cash flow was greater than 5% for me, right? So I'm cash flowing immediately. Um, and I can probably refi that building in a few years and pay off the line of credit that I used to buy the building, right? So the line of credit's temporary. It's recycled money. You borrow it, you do some sort of business deal, you pay it back. Okay, so you're still earning that 8% on your 2 millions in stocks. And when the banks look at you and they qualify you for loans, it still shows 2 million of liquidity in your Ameritrade account. Okay. they do ask you to disclose lines of credits and what you borrow, but they don't always track what they're tied to. And so a lot of banks or lenders will just like not even notice that 1.5s came from that 2 million. They'll just give you credit for the 2 million. So it just depends on the lender. And then let's say you're earning an 8% cash flow on that building you bought, right? So you're paying 5% in it has to be cash flowing. So this building you buy, it has to be cash flowing, or you have to get cash quickly. Whereas I
So you
saw
can
somebody
service the
the other
debt.
day say, "Hey, can I borrow at 5% and then do this deal?" Well, you mentioned a deal that had no cash flow and had no short-term
Yep.
cash. I'm like, that's a terrible idea. Right now,
Yep.
you're paying that 5%. So if the building had like an 8% cash flow, now there's like a net 3% positive, right? So that's good. Or like we talked about, like you're refining in a year and you're paying off at 1.5. I think that's like the simplest concept that I've
So
seen the most.
yeah, there's another. So
Yeah,
there's always has to be, you have to service the debt or you have to maintain the same loan to value, right? That's the key. So one of those two things. And when I state that is like securities backed line of credit, like you, as long as you maintain the same 70% LTV, meaning your stock price is higher than that, you don't necessarily have to pay down that loan. Not always, right? That's what they're talking about with some of these because you'll just keep reappraising, right?
yeah.
And letting that loan balance accrue. And as long as the interest rate that is accruing on that is still maintaining your same LTV, the banks don't care. So yes, your debt is growing, but your asset is appreciating at a faster rate than that debt accumulates. That's a riskier way to do it, but I'm just saying that's one way they
They're
allow it.
allowing that, no payments, just accrue, just the interest accrues.
Yeah.
Oh, yeah.
Yeah.
That's even better if you got a good deal. Yep.
Yep. So that is one way, but the more common way to service the debt is that you are investing in an asset that is producing cash flow, uh, or some kind of appreciation that again you can pay back the note, and you're taking that arbitrage between what you're getting it lent to you at versus what you're returning, and that's the basic concept. So
Yeah.
I can state too, like, so I had to do a closing maybe a couple months ago. And so the notary came out to me like a mobile notary. We're very familiar with those, right, Josh? I think you were in Seattle once and your mobile notary was trying to find you downtown.
That was like 3 weeks ago at the hotel. It was
Yeah.
chaos. Yeah. Yep.
Yeah, so when you're closing a lot of deals, there's a lot of deals that require you to do like a wet ink, right? A wet signature, they call it. They need to come out to you. You have to sign all the loan documents, and then the mobile notary will take all those back to the bank. They're kind of hired as the third party. But anyway, I was talking to one the other day, and he's like, you know what someone did? He said there was a guy right during kind of the COVID times when interest rates went down to like 2.8% or whatever, and he owned a lake house not too far from us. It was like a $2 million lake house. He owned it free and clear. So he took out $1 million line of credit or HELOC, right, against his house and locked in a 25-year HELOC of like 2 point. Yeah, I don't know how it was 20. It was a long, he said it was a long fixed rate period. I'm not sure what it was, but it was, 2.9% or something like that. And he just plowed it into the market, right? Like market was down during at that time. Interest rates were down. Like he didn't have to buy, stocks. He could have invested in a piece of real estate or whatever. But I think that worked out pretty well for him based on timing. So those are good.
So, yeah, I mean, if you can get these are like the little nuances, right? Like interest accruing on a saving max line of credit, right? Like if you got a really good deal, that's a nice little nuance to have that some people offer and some don't, right? So if that's really what you want, go find the one that does. And then a fixed rate HELOC. I didn't even know that existed. So like same thing, right? Like it's like, oh, you can get a fixed rate and like lock the bank in for a while.
Mhm.
If you can find one of those, that's going to be hard to find. But when you do, right, sometimes you can find those. It's like, dude, like that's super smart to get it fixed that low. I love it.
And and I think that's because he had 100% equity in his home, right? Like you're not going to get those same type of terms if you have 30% equity or 50% equity, right? So possibly he also is obviously a wealthy person who owns a $2 million, home, right? Like free and clear. So he's probably has I should say access to cheaper debt in general.
Yeah, like two things that always keep in your brain. The bank is not your friend. We can break that down more in the future. And then two, Um, oh man, dang it. I'm too old.
Senior moment, not enough caffeine today.
Oh, I need more caffeine. Yeah. But yeah, you were saying, okay, we'll move on.
Yep.
So I think another concept I want to say too, so we do this on a real estate project. So the when I calculate a return on cash, um, invested, right? I want to maximize that, right? I want to maximize our return on cash invested. And so what I do is I think to myself, look, equity is the most expensive, right? Like when I bring my buddies on board on a deal, like I just talk about average historical, stock returns 8%, average historical, real estate returns 16% a year. Okay. So if we're just using that as like a rule of thumb, right? Hey, some deals you can't predict, right? So some deals might be more, might be less, but in general, just average historical return 16%. So when I think of cost of capital, okay, if I'm going to do a project, how much is that money costing me to do the project, right? In equity, like if this average equity is 16% return, then I'm thinking to myself, the cost of bringing in more dollars, bringing in more investor dollars is going to cost the current investor 16%. Okay. So when I look to get the highest returns for my friends and myself, it's always like, okay, I got to mitigate risk here. We got to have some cushion so we can sleep at night. But the least amount of money in from investment money, the better, right? The more from the bank. And so what I look for is banks that will let, just like on the saving back line of credit, they'll let that interest accrue. Okay. And they'll upfund the interest expense. Okay. So we're doing level 400 today, which means I actually got to talk about complex stuff. When Reed said level 400 only, I'm like, great. Then I got to talk about complex concepts. So what I will do on loans is I will find a lender, okay, on like one of my real estate developments. And this is a short-term loan, okay? Like it might be long-term, but I'm gonna refi out this loan without penalty, usually with agency debt. Okay, so this isn't a long-term loan. But let's say I'm getting the loan, let me just use simple numbers, so like 10%. Okay. As I pull money every month from that loan, it's like a line of credit with the bank. Like basically, when I build a building, I don't take $15 million from the bank when I sign the documents because then I'd have to pay interest on
You
that
take it in
15 million.
draws. You're
Yeah.
talking about taking it in draws.
Yeah.
Yes.
So as I
Yeah.
build a project, like let's say I'm doing a project, we'll keep it simple, over 12 months. Okay. And let's say instead of doing a $12 million loan up front, we're doing a million a month. Okay. So I'm only paying interest on that million. Okay. And let's say it's a 10% interest rate, right? Or a 12% interest rate. So 12% interest rate divided by 12 is simple math. It doesn't work exactly like this. That's 1% um, a month, right? So on that 100 grand, on 1 million, right, I'm paying 10 grand in interest. Okay. And then month two, it's 2 million I owe, and I'm paying another 1% on that. Okay. When you do that, you have to kind of like pay that interest as you go. Okay. But some lenders will allow you they'll upfront the interest expense. They'll give you extra money loan to pay off the interest expense so you don't have to pay it out of pocket. Okay. So one of my little tricks,
That's nice.
yeah, one of my little tricks is I get the banks to one fund the interest expense for like a year at least. So I'm not paying any of that interest. Okay. Two, um, um, I'm letting that interest accrue too. Okay. So it's basically like there's no money out of pocket, right? And so if I'm thinking, okay, me and my buddies alongside me or putting in 2 million in cash, oh great. Now we're only putting in 1.5 million in cash, right? And so if we're putting in 25% less, our returns are amplified by I have to think about the math there, but like by 25%. I've just increased our returns by 25%. 20% of the aggregate. So if our return was 16%, I've increased to 16 by 25%.
So,
Okay.
so simply put, this small lever of you allowing interest to accrue and actually taking a loan out to pay that interest, right? That's essentially it because the bank's paying the interest. You're not diluting down your common equity, which is your investors. You can have that they're basically their returns don't get diluted because you're
Yeah.
relying more on cheaper financing or
12,
equity via the
12% for debt versus
yeah.
16% for equity. In reality, it's not 12%. Usually it's less than that, right? And
Yep.
so, yeah, you're amplifying returns. Yeah.
And it's all those small little things. This is why I like real estate. This is why you like real estate, right? Is because that seems like a subtle thing, but like once you learn that and that's something you can ask for and you know the banks to go to for that, then you just repeat for the next one because you're like, hey, I can squeeze out, 4% more return for all my investors, or I'm just throwing out a number because I know this one strategy. And right now, and that's just on the debt side. That's not on the operational efficiency of building the project, getting it leased up, et cetera, et cetera. So yes, like complexity comes with it a lot of work, but you have more things you can control and therefore more return that you can squeeze out of the deal.
Yeah, I mean, I got a deal right now. We'll have to break down a lot to show you, but is the lender listening to this podcast? Hopefully not. Like, I mean, if you think of like a typical deal, like 20 million, we're bringing 5 million in cash, right? Um, I'm probably on this deal instead of bringing 5 million the way I have it structured with the lender, I'm probably bringing 1 million.
Oh, geez.
Yeah, and it's just by layering this hack and like one or two other hacks and probably two other hacks on top of each other, right? And finding a lender that is flexible enough to do it. Okay. The more anal your lenders are, let me give you an example of a typical anal lender. It's we want you to put in 25% of the cash for the total cost of the deal, and we need all that money in the bank account up front. Okay. And you are funding the first 25% of expenses. Okay. After you exhaust your $5 million and pay all the first 5 million of expenses, then with our loan, we'll start paying the other 15 million. But you have to spend all that 15. You have to have all the 15, you have to spend all the 15, and you have to fund the interest expense account.
Well,
Okay, that's like typical local bank, right?
yeah.
They've lost money on some deal, and so over the years they just keep putting in more like requirements,
Contingencies. Yeah.
right?
Things you need. Yep.
So, you got to find somebody who's not as sophisticated. And some of the credit unions, are just like they don't quite have the commercial chops, the experience, right? So they're often more flexible. Debt funds are more flexible. So, yeah, sometimes if you can just find that really flexible lender, that's how you can just double your return threshold just through finding the right debt partner.
So you should, and I wonder, I know that also you talk about credit unions and stuff, but when you get to certain project size thresholds, you have to use the more sophisticated lenders, right? Because some of those smaller guys can't loan up to that unless if it's a debt fund. Debt funds can go pretty high.
Yeah.
No?
We,
I
we
mean,
got a debt.
is that what you, is that
Yeah,
your,
we
so
got,
let's,
yeah. I
so
mean,
just quick outline, like, hey, this is where I'm going to local banks for this amount, credit unions for this amount, debt funds for this amount. Is there like, it's going to spill over into that other type of lender
yeah,
of
yeah,
the
yeah,
project size?
yeah, yeah, yeah. I do. Sometimes your local banks can syndicate, which means syndication just means pooling of money, right? So
Partner finance.
sometimes the banks can syndicate where they like reach out to other banks. They're like, hey, we don't want to take all, 30 million of this loan. We'll do 10, you'll do 10, and this third guy will do 10. So like three banks will come with 3 million, 10 million each to diversify their risk. Um, but I think I do want to say it's really funny. I think it's a fallacy to believe that the bigger they are, the more sophisticated they are. Because when you think about it, like you've heard stories of this, right? You've watched like the Wall Street movies, right? Like
Mhm.
these guys just make phone calls and they raise like $100 million, right? And you see how like salesy and cavalier they are with raising this 100 million, right? And so think about it. If it's a sales guy who's raising like this 100 million for his hedge fund or 200 million, and his expertise is like sales, his expertise is not auditing and like underwriting structure, right? That's not his expertise. And so the older, more sophisticated, larger funds, yeah, they might just come at you, right? With real teed up requirements. But dude, this last year, I've met so many funds out there that are so flexible, right? They're selling it, they're raising money, they're selling the story over here, right? And they're doing their due diligence as best they can, but they are not institution. They may be institutional in their capital raising, like the amount, like the
Crazy.
size of their fund, but they are
But
not
not in their due diligence.
not their due diligence. It,
No.
it doesn't correlate.
Yep.
So, and I would actually say it's easier, right? The credit union or the local bank that has a $5 million limit on their loan, I mean, they might be teed up, right? They're like getting DNA tests on you, right? And then like these funds are just like they're vetting you as like a person, vetting your track record. They're looking all this stuff, right? But their goal is to have a high return on their time, right?
Yep.
And so they're really vetting the person and then vetting the deal on like a high level, but getting into the weeds on like loan structure and stuff. They're pretty flexible, and they often will put the bad boy carve outs in there, right? So
Yep.
they're it's a personal guarantee, but it's not a personal guarantee.
It's not recourse, but they put in a few other contingencies just in case if you're doing something
If
fraudulent,
you're sleazy,
that they can
right?
still come after you for
Yeah,
it.
then they come
Yes.
at you.
Yeah.
So I've
So
just found in life this is the reality.
So I want to talk about two things then, just so people know. Like most small loans are recourse, right? Personal guarantees. Most of us, when you first start investing, when you buy your practice, I mean, all of that is usually recourse, personal guarantees, meaning that if you default on the loan, they can come after you personally. Everything goes to you personally. Now, non-recourse loans typically occur at bigger levels. So I don't know. There's not a hard cutoff, I would say, but from what I would see more when they get into that $7-10 million range plus, right? That's when you're getting more into that. It depends, right? But then to be more non-recourse once you get bigger. And
Yeah,
this
so
and
yeah,
this
go for it.
means, sorry, I just will wrap this problem this
Oh,
up. This means that at that point, your loss is usually capped with the investments, and unless if you do something fraudulent or I don't know something sleazy, as Josh said, they're not going to come through you to you personally. The investment might fail, like that property fail, that business fail, but you yourself are isolated to the losses within that project. If people
and,
don't consider that.
and where this comes from is like large, sophisticated folks who need money. Okay. They've seen investment cycles, black swan events where people get wiped out, their friends get wiped out, right? And it's like you never could have seen it coming, right? So these guys that like, let's say you're worth 100 million bucks, okay? When you're worth $100 million and you're a business guy doing business deals, okay? The marginal value of you making another 10 million is not going to increase your quality of life. Okay. But the marginal loss from going from 100 million to zero, right? You lose everything. That's drastically going to affect your life, your family life. Okay. So a $100 million business person with business deals who needs debt is not going to sign a personal guarantee. Okay.
Mhm.
You see this in real estate with leases, right? The big corporate, like people don't personally guarantee, they have it on the corporation, right? So, like, you're not going to see personal guarantees. Okay. So, if I'm a lender, right, I could work with small people, but if I want to be a big lender that works with big people, right, that does big loans, a better return on my time, I know these people are not going to sign personal guarantees, right? So, I need my products, if they're going to be competitive, not to have personal guarantees.
Mhm.
Good.
We were trying to pitch a deal to get a refinance done to pull out some cash. And it's been a hard deal to find a good refinance partner on it. And I remember going to one lender and they're just like, these would be our terms, but the one term you're probably not going to like is that we're going to require recourse on this. So that might kill it for you, right? Like they're already looking and they're telling me up front, like, this might be a deal breaker. So I just want to tell you up front that we're probably going to have recourse for this one. So, like that's in my early days, everything's been recourse. So it's not been such a big deal. But as you start to level up, as Josh said, and you start to accumulate, you start to think of like, I need to protect that. Like, there's no point in me just being overly cavalier here and taking shots at things where I could just shrink back to zero, right? Like, you don't want to do that. So this is again level four wealth, right? Once you've accumulated something, I'm not saying I'm at level four. I'm just saying in general, when you get to that point, you have to start thinking strategically from a defense standpoint of like, I'm going to cap my losses so I can always have that safety net, whether it's 10 million or 20 million or 100 million, whatever it is. So these are good things to think about. Even if you're not there, it's like begin with the end in mind, knowing like here's the steps to take where eventually I'm going to get to this point. So yeah.
So
Oh, go
yeah.
ahead. I have something
Well,
else I want to say, but
I just want to frame this back to where we started, the wealth game: earn dollars, buy assets, borrow smart. So we're talking about, as you develop real, like, substantial wealth in life, right? Financial wealth. This is part of the borrowing smart, right? Not just borrowing to amplify your returns, but borrowing to mitigate your risk.
yes.
Uh, yeah.
Yeah. No, that's good. Thanks for tying back. But I wanted to say something about um people, right? Like you said, some of these bigger institutions or debt funds don't necessarily have the in-depth due diligence that maybe they should, right? Maybe because again, they're talking about return on time. But every institution, every lender, all it is hung up by people, like held up by people and process, and people are fallible. Like you learn this. Like you think you interact with some really big people and you think to yourself, "Oh my gosh, like they're making mistakes left and right or why didn't they look at this or ask this question?" And you just realize that like people are fallible, right? Like they're going to make mistakes. And so I think that's been eye-opening. Attorneys, CPAs, like don't take anyone's word as like this is the gospel truth, right? Like question everything. Have a healthy dose of skepticism with every conversation you have, even listening to us, right? Like we are not, everything we say is not truth necessarily. Like you should have a little bit of skepticism and know that people are fallible. So,
I think that was a big lesson for me to read. Absolutely. Yeah, I remember I mentioned this before. Like one of my attorneys, they were doing a deal in Washington, and I read through the document. It had Texas listed 5 times, right? Like I could have drawn up a lease. I was hiring this real estate attorney to be more detail oriented than I was, not to miss anything. We're in Washington. He has Texas listed 5 times, and whatever contract he started with to turn it into ours, he didn't even replace Texas 5 times. So,
yeah.
and this is like nerdy attorney, like stereotype. Like you just look at him and you're like, okay, this is like a very detail oriented and nerdy attorney. Like I think this would be his strength,
Mhm.
not right. So, um, yeah, that was one very clear lesson. And then just kind of everybody, you start talking to people. Like I have friends who work at the bank, right? And I'm thinking like everybody's like teed up and like on top of it internally because one of the biggest banks in the area. And I'm talking to him. He's like, yeah, dude, this person doesn't know what they're doing. This person doesn't know what they're doing. And it just and like, yeah, this guy was actually good, but then he left and we replaced him with a new guy. He has no idea what he's doing, right? And these are all the filters saying if I get a loan or not, right? Like the left hand doesn't know what the right hand's doing, right? And so what I've learned in life is actually the high like um dentistry, being a dental owner. Okay. Being an owner of a dental practice filters for successful people who have the habits and the strengths to be successful. It brings it out of them, right? They're in there somewhere. It brings it out of them and then it filters. So like the people I respect most in this world, like on average now, are successful dental practice owners. Like I would take them and go to battle against any of
Yes.
these other like trades, like bankers, financial institutions. Like, yeah, they might be
We just
smart because they've been doing it, right? And this is what they learned. But if I took like a smart group of dental practice owners, within 5 years, we'd be destroying those other guys. Just my personal opinion.
so I'm
Uh,
getting like goosebumps a little bit because I agree so much, right? Like it would just destroy. Like if you took 100 dental practice owners that are crushing it, they could do anything, honestly, right? Like, and I've interacted with so many, seemingly impressive people, and I'm just like, oh my gosh, like my peers over here are just like I'm more impressed by the doctors I talk to every day than
Yeah.
the professionals in other industries. Just like on all aspects, right? Like they know how to handle people, conflict, they know systems, they're detail oriented, and they're tough as nails. Like when you own a practice and you're a successful practice, like you are just tough. You have thick skin, you can handle adversity, you can overcome almost anything. And so I'm with you. Like the obstacle to go through dental school and then the big obstacle to build a successful practice is so great that the person that comes out the other side of that is just like battle tested and will kick butt. So this is like that's like my battle cry for all of our dentists and peers here.
And we're not saying, oh, dentists are smart, right? What we're saying
Yeah.
is you take a smart dentist because you got to get through dental school. So you got to be smart like academically, right?
Hmm.
You get through that, you start or buy your first practice, right? You just get ambushed with HR issues, financial issues, marketing issues, right? And that does two things. One is it brings the best out in you, right?
Yes.
Like it turns you into like a ninja, right? With these skills, right?
Yep.
Obviously dental skills, but leadership skills, right? With people and then business skills. So it brings out these ninja leadership and business skills out in you. So it's part that, and then so part of it's like innate in you. It's just had to bring it to the surface, and then two is it teaches you things, experiences, all these things, right? That you're picking up as well, externally. So it's yeah, both of those.
It's also like this profound responsibility that everything is on you that
Yeah,
doesn't exist everywhere else, where people can point fingers and shift blame. You
yep.
can't do that as a dental practice owner. It all comes back to you. And I think that extreme personal responsibility is also what kind of creates this tough, very capable individual.
Well said. Well said. Um, yeah. Yeah, it's the ultimate, and the ultimate example of this for me actually is if I had to create like a recruiting pool, okay, I would only recruit comfort dental dentists, okay? Because in comfort dental, there's no hygienist,
Yeah.
there's no treatment planner. Like you think everything's on the dentist when you're a typical dental practice owner. If you're a comfort dental guy, like you are just like you've been dropped in the battleground, right? And if you survive that and are successful in that, you come out at success with very good success habits, right?
Hmm.
Maybe you need to learn how to delegate because
Yes.
everything's been on you, right? But I think that's a fantastic like recruiting pool would be Comfort Dental, like these people have been well trained. It's like the Green Beret of dental practice ownership, right?
They're like the Swiss Army pocket knife
Yeah,
of dentists, right? That
yeah,
can do everything.
but yeah, yeah.
And
And
yeah,
then
I can't
everything
imagine
else
what that clinical day looked.
after that, when you've been a Green Beret, right? You've been in war zones, everything else seems easy, right? Same with
Yes.
comfort dental dentist. You talk to a comfort dental dentist about, hey, could you do this? They're like, yeah, no problem, right? You talk to a dentist, who worked for somebody else, and then they're like, I don't know, I don't want to look insurance, I don't like insurance, I don't want to look at it, and you're like, okay, well, your own fear and your own like stereotypes are holding back your successful growth path, right? But a comfort
Yep.
dental dentist doesn't have that. Like anything's on the table.
I'll ask you this. Do you remember, so when you were in school, whether it was undergrad or dental school, there'd be a subject matter where you just felt like resistance in your brain that it was like, I can't, like nephrology or something like that, right? Like I was like always had to relearn nephrology, or whether it was advanced calculus, like you get that resistance where you're like, man, I'm not getting it, but I have to keep plowing through because I have no choice but to get this thing, right? Like it takes a lot for me to get there now. Like at first when I started real estate, I'm plowing through contracts and operating agreements and legal leases and all that. Like I felt it a little bit, but man, it takes a lot for me to get there because I think, right, of all those years of like you have to keep pushing on that barrier till you get through, and then the next one till you get through, and you just have no choice. So I just think I always want to tell Dennis like you are so much more capable than what you even know because you haven't seen you haven't encountered the rest of the world sometimes in these other professions. So Yeah, just want to kudos to our fellow dentists for such good practice owners.
Uh, well,
Well,
as Reed mentioned today, level 4 financial freedom. So if you're a little confused by today, that's okay. That's what we
hmm,
were doing, some a little bit more advanced concepts. My goal here is to educate, but my goal is also to plant seeds and present concepts that may challenge the mental constructs that you view the world by, right? To help you. And I'm not saying I'm right. These are just my personal experience or my personal but I do like to put these out there to get us thinking, right?
yep.
And help us, get outside the bubble we've created for ourselves, right? Where does the magic happen? Outside the circle that you're in, outside your comfort zone, right? And so I do like to challenge that. And any other final points for folks today, Reed?
No, I think that's well said. I mean, sometimes it's just like, just feels it's fun to think about these concepts. It's just intellectually stimulating too. And I think that's what makes it fun. I think we all enjoy that. Like it stretches the mind a little bit, even if the concepts are a little abstract. And whether you can apply them now or in the future, like it's not relevant. Like sometimes you just got to think a little bit differently. And that's I think what we're trying to do too, is get people to think just a little bit differently, expose them to some new topics, and then hopefully they can apply some of the concepts to their lives. So yeah, that's all I would say.
Get unstuck, right?
Get unstuck.
Yeah.
Yeah.
All right. Well, that's a wrap.
Thanks for joining us today. If you want to connect with us directly and keep the conversation going, join our private Facebook group. We'd love to have you in the discussion. If you want to see or listen to any of our other shows, you can find them on our YouTube channel by searching Dental Real Estate Partners. Or if you prefer to listen in podcast format, look for us on your favorite podcast app or streaming platform.
Content from Dental Real Estate Partners is for informational purposes only and should not be considered financial, legal, or investment advice. All investments carry risk. Past performance does not guarantee future results. Always consult a qualified professional. Dental Real Estate Partners is not responsible for outcomes from actions taken based on this content.